Hey everyone, welcome in to another daily editorial here on the KE Report. We're chatting with Craig Hemke. We're going to be focusing on the Commitment of Traders report, some interesting changes that we saw in the last report, and as that report usually takes positions from Tuesday, the subsequent fall in the gold price after that, after gold was making a nice run last week, closing in on 2,500. Well, then it dropped about $80 just in a matter of days. Again, shortly after the CoT report captured some of that data, which we saw on Friday. Craig is the founder and editor of TF Metals Report, which we will link to in the show notes. Craig, take us through some of the changes that you saw in that CoT report from last week, please.
Can I start by just complaining about something? Would that be okay?
Yeah, we like your complaints. They're usually pretty entertaining.
Okay, good. I will never believe that there is a fair, reasonable explanation as to why it takes 74 hours from the COMEX close at 1:30 on Tuesday to the issuing of the Commitment of Traders report at 3:30 Eastern time on Friday. Now, look, I understand it's not just gold and silver. I mean, anybody can go to the CFTC Commitment of Traders reports page and see all of them. Grains and cattle futures and equity futures and bond market futures. I mean, there's a lot of them, right? But we're talking, this is a federal government, for God's sake, right? I mean, and this is just information that could be submitted electronically, put into spreadsheets electronically, and they could have this information out on Wednesday. They don't have to, and then God forbid there's a holiday in the middle of the week. Then you don't get it till the following Monday. So again, I think this is done deliberately. It's all part of the opacity, if you will, of the precious metals markets. Anyway, I digress. Yes, last Tuesday, the 16th, gold, spot gold, and the futures price knew all-time highs. Everybody's excited, even me. Hey, look at this. Maybe we're breaking out. And then what happens? Even with the dollar falling late last week, gold and silver both start to decline, and then over 24 hours from 10 a.m. on Thursday to 10 a.m. on Friday, gold basically went straight down, nonstop, at a 45-degree angle for 24 hours and lost $70. Okay, so if what I'm about to tell you about the Commitment of Traders report, if you'd known this on Wednesday, maybe a sharp trader could have maybe missed or avoided that loss. We got the CoT report on Friday. Again, this last Friday, the 19th. It was surveyed last Tuesday, the 16th, right? At that close, you get this information then on Friday. And what did it show us? Within the gold market, the large speculators, which is like hedge funds and home offices and high net worth people and trading funds, and okay, put them all in one category, call them the large speculators. They were net long, or if you subtract the short position from how many they're gross long, they were net long, the most they'd been in years. And the last time they were that large of a position net long, price fell $134 the next 5-day Commitment of Traders week. The last time they were gross long, as many contracts as they were last Tuesday, price fell $117 over the next 5-day Commitment of Traders week from Wednesday to Tuesday. The last time the commercials, which is producers that hedge, the bullion banks that manage their positions and take the risks of being short themselves. The last time the commercials that were net short, as many contracts as they were last Tuesday with price at all-time highs, price fell $122 over the next 5 days. So if we'd had this information on Wednesday and you had access to all this historical data, you might have on Wednesday gone, yeah, I think I might take a few chips off the table. But by the time we got it on Friday, again, price was already lower. So at the end of the day, this is nothing new. Anybody that follows prices knows that on COMEX, you don't just go to the moon. It's 2 steps forward, 1 step back. A bull market is just a series of higher highs and higher lows. And this one is no different.
Yeah, Craig, you said it. And like you said, if we'd known this information on Wednesday, it may have given people the opportunity to ring the register when they saw all the commercials net short and all the speculators net long. That's usually arbitrage for a price correction. But when you look at silver, it's also been in the hurt locker the last couple of trading days. Anything that you would glean from the CoT report on the silver price?
Well, it's a little heavy as well in terms of how many contracts the speculators are long versus the commercials that are short. But it actually, I guess, improved a little bit last week. And it's not nearly at historical extremes. I mean, it's not like it's completely bullish extremes where, those rare occasions where the bank or the swap dealers are long, but it's not like flashing red lights. It maybe flashes caution, but it's not like, oh God, we're all doomed. Affecting silver is something we discussed a lot back in the first quarter of this year. Remember, gold finally broke out on the 1st of March, posted new weekly closing highs, broke out of the range it had been in for 3.5 years, and then just took off. Went $100 that first week of March higher. Eventually, then add another $200 by the middle of April. But you remember in March, silver wasn't doing anything, and it was driving everybody. Why is silver still $24 when gold's $2,200, $2,300? And we're all going crazy. Well, at the time, as we talked about it, remember we discussed silver as this kind of amalgamation of gold and copper, in that you got gold as a monetary metal and you got copper as an industrial metal, and silver kind of in between, a little bit of both. And so if you think of it as like a barbell with gold on one side and copper on the other, a seesaw maybe. If the gold side goes up but the copper side's going down, in the middle there's no change. And that's kind of what was going on with silver back in March. And then finally copper began to take off, and then wow, here went silver from 24 to 33. Well, what has happened since? Copper is now back down. Copper peaked at $5.17 a pound on like May the 17th or May the 20th. It's now $4.17 a pound. It's down almost 20% 2 months later. If silver had fallen 20%, we'd be talking like 26 or 27. Instead, it's been caught in the middle. Gold's gone up, copper's gone down, and silver is, lingering here between 29 and 30. So that's the biggest drag on silver, frankly, is that the copper's not doing anything.
What about the volatility in silver? We've been seeing almost dollar plus moves, not every day, but maybe a couple days a week. You go back to 2021, even before the pandemic, man, silver was moving a couple cents every day. Much more volatility. What does that speak to you about the market?
Indecision, I guess. I mean, we could go into other topics, I guess, but when I see big ranges like that, a big green candle followed by a big red candle, it's just, the traditional term is choppy, indecision, not really ready to go one way or the other. You get that a lot of times when you are in a range, and that's exactly what we are. The good thing about a range, though, and I referenced this a second ago, gold was trading sideways between 1,600 and 2,000 for about 3.5 years, from the middle of 2020 to the first part of this year. And when you're in a range, a consolidation phase for a long time, even Stevie Wonder can see it. Okay, so when you break out, everybody at the same time goes, oh, wow, it's a breakout. And it can be dangerous on the downside, too. You break down, everybody goes, oh, crap. And so you get traders that, put a sell stop to their position below the range because if it breaks down, I got to get out. Well, the same thing is true on the upper side. If it breaks up and gets out, I better cover my shorts or I'm going to get long because there's all this new momentum coming in. Well, gold broke out, and like I said, it went up $100 the first week after it broke out, and another $200 in the 6 weeks that followed. Silver's, and now we're in a range again. Gold's been in a range since April. Silver's been in a range since May. So again, as long you're chopping back and forth within the range, and so that's where this volatility comes from. And you can't seem to string more than one or two green candles together before you get a big red one. What we're waiting for is that next breakout. As we discussed last week, I think that's coming. Seasonally, August into September is about the second best time of year on average after January and into early February. The economic data is trending in our direction. The amount of possible rate cuts, even still this year, is trending in our direction. And so I think a storm is coming for that next 2 steps forward rather than this current 1 step back. I could be wrong. I've been wrong before, but I still think that we're probably set up. Once we get through this next 5 or 6 trading days, I think we're set up for a good month of August.
Well, Craig, just thinking about the ranges, as you mentioned, and when things break out, it's obvious to everybody. That is important for both gold and silver right now, as they are stuck in a range. And you brought in the seasonality that often coming into the late summer, like that August time period, kind of going into September, into the fall, it really does transition into a more bullish time of the year seasonally for the precious metals. But there's also a lot of economic news that we have on tap in the next couple of weeks. We won't have you with us next week, so or maybe the week after that. So I'd love you to look ahead as to some of the key data that you think could move the markets, maybe change the Fed policy, or at least update Fed policy. What's on your radar for economic data?
Well, I think we should start with the COMEX calendar before we get there, and why we might still kind of fiddle around through the rest of this month. This coming Thursday is option expiration on the COMEX. So at the COMEX close on Thursday, all of the August calls and puts will price and expire. August, a front month for gold, so there's a lot of volume and open interest in the August calls and puts. So that's going to factor into the trading as we go through this week. A little bit for silver, even though September is the next front month for silver. So we got that. Then we got the August contract going off the board and into delivery at the end of this month. I think it's the 30th that it goes off the board. So what's that, a week from Tuesday, a week from tomorrow. So we talk about all these large speculator long positions. Most of them have been in the front month of August. Well, those speculators, they're just traders. They're not looking to take delivery. And so what do? They liquidate their August long, and then they go out and they maybe buy a similar position in December. But sometimes when you're in a range and there's not much excitement, or you're in a declining market, say you're a hedge fund manager and you've got 100 contracts you're long COMEX gold, but the price is declining and the trend's not in your, maybe you think, well, you know what, I'm going to dump my 100 August, but instead of immediately buying 100 in December, I'll buy 50. And then I'll wait till next week, and maybe I'll then at a lower price average in, that kind of thing. Well, if we do that often enough, that's right there 50 contracts of net selling pressure, right? You go from 100 long, sell 100, you only buy 50 back. And then you get enough hedge funds and the like doing that, open interest collapses and price goes down because of that net selling pressure. So we got to navigate that over the next 5 or 6 days. But then, now to answer your question, later this week, we get some economic data that is going to move. The quarter GDP is going to be released either, Wednesday or Thursday. I can't remember which day it is. But then Friday comes that PCE report, which everybody always says is the Fed's indicator. So that's going to move the needle. Then we get into next week, and we get the July FOMC and a Powell press conference where everyone's going to be wondering, how certain is Powell? Is he going to be hawkish and dovish about maybe a rate cut beginning in September? And then we're still not done, because then Friday, the 2nd of August, will be the first Friday of the month, and we'll get the next jobs report. So by the time in 2 weeks, all of this stuff will have worked its way through.
Ooh, Craig, I think we got most of that. Little technical difficulties there, but overall, hey, a lot of economic data to come. I'm sure markets will be volatile on the back end of that. I do want to look a little further ahead with you, and I don't want to talk politics, but we do need to address the fact that the election is coming. A lot of people are talking about this Trump trade. It's been on a lot of our guests' minds. When you have an election year like this coming up, what do you usually see in precious metals prices? What sort of impacts, at least short term, can politics play in this?
Counter. I recall back when Biden defeated Trump, the immediate reaction you would have thought would have been positive. Like, oh, here comes a big spending Democrat, and he's going to have big spending Democrats in Congress. But the immediate reaction was down. I remember like that following Wednesday, I was like, what is going on here? So sometimes it can be a little counterintuitive. It's hard to say at this point which is going to be in charge of both the executive but I would just remind people, I don't think Trump in his first term was necessarily a deficit hawk. The deficit just continued to expand and grow, and the spending continued to grow while he was in office. If whoever takes over in January next year is probably still going to be dealing with a recession. And a lot of times you get massive spending programs in the first 100 days. We're thanking certain constituents for their support. So you get a lot of government spending, but at the same time, if we're in a recession, tax receipts and revenue that are flowing. So we could very easily, regardless of who wins the election, be looking at some of the largest annual deficit numbers we've ever seen, well in excess of $1 trillion in the next fiscal year. That actually begins on the 1st of October. So all of this just will continue to compound. I think we'll all ultimately know where this is headed. This is headed towards some type of yield curve control and quantitative easing and everything else just to keep the wheels spinning in government. And that's very positive. That's all part of the reason why we own physical gold and silver, is a hedge against that kind of stuff. So in the end, I guess I wouldn't look at either party as being responsible and willing to do what's necessary to try to get this situation under control before it all implodes. So whoever does win, I think we're all still progressing toward what we've always called the end of the great Keynesian experiment in this debt-based monetary system.
All right, Craig, always great chatting with you. Sorry, everyone, about some of those technical difficulties. We'll try to clean them up in post-editing, but I think you get the overall point here of what Craig's looking forward to in terms of economic data and what sort of role politics always plays into this. Even when parties change, things still many times stay the same. Craig, thank you very much for your time. We'll chat with you in another couple weeks. I hope you have a great rest of your week.
Thanks, guys.